How to identify multibagger stocks? Everyone is in search of multibagger stocks. Everyone wants to look for next multibagger stocks. But what are the important things to look for in multibagger stocks? People talk about all types of ratios: EPS, ROE, ROC, PE, and so on. It gets very confusing seeing all these terms, and we don't know which things to focus on. But we need to focus on only 5 major points to identify a next multibagger. So in this video, I am going to tell you those 5 most important points. My name is Hemant and you are watching my channel Smart Investor. But before I start, subscribe to my channel and hit that bell icon so that you get notified every time I post a new video. The first point to focus on is the revenue of the company. The company should increase its revenue year by year. You should focus on at least last 3 to 5 years of data for revenues of the company. The company sells the products to the customer and therefore the sales should increase with every passing year. How would the sales increase? It can increase by the number of products sold or it can increase by price of products sold. If both volume and price increase, then that is the best thing. Now what is the expected rate of increase in sales? I would say at least 10% increase per year is expected. It can happen that in 1 year the sales might have decreased because of some unusual circumstances. Like for example, recently COVID-19 has impacted the sales. So we should look at the trend for 3 to 5 years and look at the average CAGR growth for last 3 to 5 years. The second point is the profit of the company. Only increasing the sales does not matter. The company should earn profits out of its sales. The profit is calculated by deducting expenditure from the revenue. So to earn profits, the company must be minimizing its expenses. The revenue should increase and expenditure should decrease. Then profits would increase with good margin. So we should look at net profits data for 3 to 5 years. I am talking of net profits here, which means profits after reduction of taxes and everything else. So we should look at CAGR growth of profits for last 3 to 5 years. Again here also, we should look at least 10% CAGR growth in profits. This is the minimum we should expect. The third point to look for is the debt on the company. The company should be debt-free company or should have very low debt. How will any company increase its sales? Let's take example of DMart. If DMart wants to grow and increase its sales, then it would have to open new stores at new locations. For that, it will need capital expenditure. It will need to lease the shop or buy a new shop. It will need to hire new staff. It will need to establish new logistics. So all of this needs capital expenditure. Similarly, for any company, it needs to spend capital to grow in size. Now where this money comes from? If the company has to take loan for this expansion, then yes, it will help in the long run, but it will increase its sales, but there will be additional liabilities. The best thing is that the company should be able to use its own money out of its profits to invest back into the business. The company may still have to take loan, but as long as the contribution of the net profits is more, the burden of debt on the company would be low. So we should always look at the companies which have a low debt and those who invest the profits back into the business to grow the business. The fourth point to look for is the management of the company. The management of the company should be honest, professional and ethical. The top management of the company, like chairman or CEO, should not earn very high salary. The high percentage of total profits should not go to pay their salary. The company should not have any legal cases against them. For this, you should check any legal cases with a simple Google search. The promoters should not pledge their shares. I have made another video for pledging of shares. The link for that is given in the description below. But in simple terms, pledging of shares means taking loan against the shares. If the company is pledging shares for investing into the business, then we can still consider it. But if pledging is done for personal purpose of promoters, then it is a big red flag. The management of the company is very important. You know what happened with Kingfisher, which was an example of good company with bad management. So management is very important since they can take company on different path with their actions. The final point is the potential for future growth. For any company to grow in future, there should be a scope for the company to grow and the market should be available for their products. This means that there should be demand for their products. For example, take an example of HUL. HUL creates daily needs household products like soaps, detergents, toothpaste, creams, and so on. Will there be demand for these products after 10 years or 20 years? Yes, of course there will be. Take another example of Tata Motors. Will there be demand for petrol and diesel cars after 10 years? Yes, there will be. But now there is a shift happening towards electric cars because the government is giving attention to electric cars with focus on environmental concerns. So unless Tata Motors shifts to electric cars, we are not sure of demand of petrol and diesel vehicles. So it is necessary to see whether the business will be relevant in long term. Generally, market leaders of any sectors have greater chance to be multi-baggers. But even other companies which are not market leaders can have chance to occupy market share if the top market leader is not the absolute monopoly in the sector. Whether the monopoly will be sustained depends a lot on competition and the barriers to the entry. If the barriers are easy to break, the other players can also gain the market share. We have to also see how big is the market for a particular product. In case of HUL, the market is whole Indian population because the products are daily essential needs and the brand is very popular. So opportunity of growth is very important factor. Many of the times the sector is unorganized. For example, take footwear sector. This sector is very unorganized. There are so many local players available in this sector. Bata and Relaxo are two important organized players in this sector. So they have a lot of potential to gain the market share with shift from unorganized to organized sector. So these are the 5 points which we should look for in identifying the future multi-bagger. Remember that all others ratio like EPS, ROE, ROC, debt to equity ratio are just the ways to express the sales, profits and debt. So we have to focus only on these 5 major things to assess the financial position of the company and to find the next multi-bagger. So I hope you all liked this video. Give it a big like and share this and subscribe to my channel. If you have any questions, then comment below and I will answer those questions. I will see you soon in the next video. Till then, bye bye.